I want to go over the latest performance for the stock index portfolio and show you what's going on today. And we have the E-mini S&P stock index portfolio as well. And they get questions on margins. And so I want to go over that. We're going to go over the margins. We're looking at the TradeStation margins right here. And I'm going to show you that as well. And you see the trades today, there's not many trades. Stock index swing was stopped out. A gap up. The market continues to try to rise, but was due for a little selling today as anticipated, and adaptive moving average is short, and so it's kind of one of those gap ups and then trades below the previous day's low. Yesterday is a very narrow range, and so we'll see what happens here the rest of the day as the market continues to be pretty strong overall. But what's interesting is I've seen a lot of what I consider permabulls say be cautious here, and I haven't heard them say that in a long time. So anyway, let's take a look at the stock index portfolio, E-mini S&P. Here is the latest performance summary. If you combine 17 trading systems, if you just take just the E-mini S&P strategies in this list, there's 30 strategies in the stock index portfolio. When you subscribe to the stock index portfolio, you get 30 strategies. If you just want to trade the E-mini S&P, when you get that set up, here are the results of just the E-mini S&P. So if you want to scale in on this and start out with the E-mini S&P, it's currently in about a $6,700 drawdown. That changes minute by minute and day by day. And so the max drawdown for this is $21,700. And so the risk to worst case drawdown is about $15,000 right now. And that is only $1,500 per micro. So if you're trading the micros, the risk to worst case drawdown is $1,500 and $15,000 on the E-mini S&P, and so that's with 17 different trading systems. So here is where we get that number. I had another performance summary on here that included an 18th system, which is an overnight strategy, and so I've corrected that, and this is the latest update. It also includes the updated tick count trend version 2, which made an incremental change, just some incremental gains, very small incremental gains. Average profit increases just a little bit. Drawdowns are actually about the same, and the total net profit goes up just a little bit. And these are the latest results. You see here it's in a little bit of a drawdown. Here's the drawdown curve, what we'd like to talk about. And here is the drawdown currently around 7K. So you have 15K from here to worst case drawdown, and you have to consider, you know, the scenario where it goes to the worst case drawdown, breaks it by a little, and then rebounds. And so you can also do that. It can rebound at any point. It can continue to go down at any point. We don't know how to predict the future for sure, but we're coming into the close of September, and October is traditionally a great month to trade. Some of the best results are in October. Let's take a look at the margin requirements. So for example, if you're at TradeStation, I'm going to pull Excel in here. You have the E-mini S&P. You're trading 17 E-minis. The day trade margin is 25% of the initial, and so we'll just take equal to 69.30 times 17. If you took a net position in all these strategies, let's get the day trade margin. This is equal to that divided by 4. So your day trade margin, if you were net on all the strategies, which never happens, is about 30K. And your risk to worst case drawdown today, right now at this moment, is 15K. So 45K would be one level of capital that you could use to trade this per E-mini, to trade 17 different day trade strategies. Now, 2 of these hold positions overnight, but the overnight margin is 14,000, so which is 14,000, which is less than the day trade margin of all 17. So if you also wanted to be a little more aggressive and bet against the fact that there would ever be a net position, this is if you had a net position. This is all 17 strategies were short at the same time or long at the same time, which I don't ever anticipate happening. So if you do, 2/3 of that level equal to 2/3 of that, well, that would easily be 20K. So if you were aggressive, you could say 20K and then a 15K, the worst case drawdown. So if you're aggressive, you could trade the E-mini stock index portfolio with 35K per contract. That's very, very aggressive. And overall, the stock index portfolio, you could make some of the same margin requirements. Now that you know that you could trade this potentially with 35K per E-mini and 3.5K per micro, then those are the margin requirements just for the E-mini S&P. Ideally, we'll go over the ideal numbers next. I want to look at the larger portfolio, the stock index portfolio, to do that. And so the large stock index portfolio trades 17 ES and 13 NQs. And so the worst case drawdown on that is 50K. 50K is the worst case drawdown. So what is the margin requirement for 17 ES if you took a net position in every single one? Same over here, it'd be 29,452.50 or about 30K. And for the ES is equal to 13 contracts times the margin is 83.60. And divide by 4 because day trade margin is 25%. So 27,170, and let's make those dollars so those line up. 50,000 to worst case drawdown. So you can sum these up. We've gone over this before. It's about 125K, 100K. So you can trade this with about 106K. It's currently in a drawdown. So the stock index portfolio is in about a 10K drawdown, and so that would reduce this to 96K or 97K. You could trade the complete stock index portfolio. The stock index portfolio is all 30 strategies with one E-mini, and which would also be so all 30 strategies with one E-mini is about 97K. So that's about 10K or 9.7K per micro. So we look at the ideal capitalization based on a percentage of drawdown. And so if the drawdown is 50K, we say 250K is the ideal capitalization because that's 20%. That's about the threshold of what most could handle. If you have 97K and you draw down 40K, you're at 50%. You're at a 50% drawdown, and as long as you go in knowing that I'm putting in the minimal amount of capital, it can have a 40K drawdown, and I'm okay with 50%. That's fine, but you should think about it in terms of the fact that the ideal amount is anywhere from 250 to 500, 10 to 20% drawdown. If you were a money manager, you wouldn't trade this with less than, probably 500K. And so you would put, 100K in your futures account. You'd put, 400K. Also use that other 400K in a conservative. You can't gain much interest. You can't get a large return from T-bills anymore or your savings account. But you would still allocate 500K, 100K for margins, and then keep the other 400K somewhere where you could earn 1%. That's about the going rate right now, if that. And so you can use that's how you would think about it if you're a professional money manager. That's how you would manage your risk. But if you are just an aggressive short-term trader, you want to maximize the return for your capital, you could trade this with 97K on the minis and expect up to a 50% drawdown, and 9.7K on the micros and expect up to a 50% drawdown. And that is the capitalization for the stock index portfolio. And again, just if you trade the E-minis, you could be as aggressive as 35K on the E-minis and 3.5K on the micros. And once again, very, very aggressive approach, but certainly possible in relation to the current margins and the worst case drawdown.